Okay. Now we are rolling.
All right. Hey guys, as in any good project, sometimes technical difficulties ensue, but I promise we have a very succinct and awesome presentation for you today. So I'm Jordan Tampion with 4 Degrees Capital and we're going to talk a little bit today about the Havana project and dive in, introduce the team, why multifamily, and really dive into what this looks like. So I'm going to share my screen with you. All right. Just wanted to confirm everybody can hear me and we can kick this off. Dave, how am I hearing? You hear me now?
I can hear you great.
I love it. All right. Thank you guys for your patience. We are excited. I promise the next 50 of these will go as smooth as most of the apartment projects. So what I want to do is we're going to share the screen. Me and Dave are going to kind of tell you a little bit about the Havana project and who and what 4 Degrees Capital is. And then honestly, we're here to answer questions for you. So without further ado, I know you guys' time is valuable and I want to make sure we respect that. So we're going to dive right in. So I'm sharing with you now the screen, a little bit about 4 Degrees Capital. We were running into an issue that I was seeing within our brokerage of the only opportunities were these single family houses. And it turned into a market where it just wasn't a great investment for everybody. And so got together with Dave, got together the team together and decided, hey, how do we present these opportunities for some of these more institutional size investments that could be available for everyone? And why isn't that more readily available? And so that's kind of the concept 4 Degrees Capital was born on and what we've been really building and developing since we started. So what we're going to talk about a little today in pretty speedy fashion. If you know me, I'm not a PowerPoint guy, but I will stick to the PowerPoint. Is I'm going to tell you a little bit about 4CAP. Dave's going to talk to you and dive in why build apartments and why we are still a firm believer, even with where the market is and what it's doing and why we're really bullish on it. Talk about the location, the project, the numbers. Then honestly, we want to be available for questions so that we can answer those for you at the end of the show. So what's awesome about this is if you have any questions during the presentation, just put them in the question chat box, and then we'll get to them all at the end and address each of them individually. So who are we? Who's 4CAP? What a good question. Everybody always wonders what 4 degrees is. What is 4CAP, right? The idea around it was that we had gathered kind of a team that brought a special skill set to the table to help find and develop very unique multifamily opportunities. And so the team's made up of David, Joel, me, and Matt. And so David is kind of the brains of the outfit, underwriting, puts the deal together, brings that kind of institutional knowledge that really helped elevate our game. Joel is the management machine that puts all of the stuff together, makes sure you're communicated with, makes that investor relations side even more effective. On my end, I'm really not sure what I do yet. They kind of really front load most of the talent. So I kind of pick up where needed. And then Matt is out there deving up deals that otherwise don't exist and finding fundraisers, funding elements and different ways that we grow. So that's really the 4-headed machine that pushes us forward. So a little about 4CAP, it really was born off the investments that we've done. And we've really found this unique product that we were able to build and sell and build and hold. And it rented well. It really fit in the market. It was a really good infill site. And so we've been fortunate enough with the developments we've done to kind of average almost a 22% IRR, which is basically your return over the life of that investment. Multiples when we sold them almost 3.5. This market's a little different. That really benefited from some of the low interest environment, but still finding pretty good returns. This last transaction volume was around 43 million, and then currently have about over 200 million under management. And all that really means to you, not really bragging about it, but it means that we've tested it, we have experience, we've looked through this model, and our idea was we only want to present it once we have that. And so I want to show you a quick clip because once you've seen one of the apartments we build, you're going to see all the apartments we build. And we're going to explain to you the reason why, but it also takes my droning voice out. So I'm going to stop here and show you just a quick video of the project we did on 4th Avenue in the Valley. And it really was one of those key projects that kicked it off. It just got completed. We're now leasing up the project and are hoping to have it full in the next few months. So take a look at this, and here you go. All right. So that's kind of a fun video that really highlights just that one project, the 56 unit out there, but really is a good way to show you what some of the fit and finish of the product looks like inside. And so it's been one of those that we've just been able to duplicate, replicate, and really we don't have a ton of input. Once the tile's picked, we pick it and move. And so that's been one piece that's allowed us to break ground on it and have it completed in less than 9 months. And so that's one thing we really like, is the speed to market that we can do with those. And so basically the structure of how it works is 4CAP is the manager of the LLC. We bring on investors for each project, and then we split out ownership. So you actually own a percentage of the LLC that owns the asset, 80-20 split. And then we handle all of it, from the tax reporting to your updated financials to all those set pieces for you. And so the hope is that we make it an easy button for development and allow you to plug into an asset of this size. So this is how Havana would set up. It's a 72 unit project, and our goal is to raise $4.5 million for it. We already have a large chunk of that raised, and so we're looking kind of for that to finish out the full raise on that side. So I'm going to turn it over to David, and we'll dive into a little bit more about this. I know I kind of skipped through, but David can speak a little bit more to the function and format, and then tell you a little bit more about why multifamily.
Thanks, Jordan. Hello, everybody. So if you can go to the next slide, Jordan, that'd be great. So historically, multifamily, we love it for a number of reasons, some of which are identified here, but historically, apartments have been an excellent inflation hedge. Rents tend to keep pace with inflation much better. In particular, one great aspect of your cash flow from apartments is that it's tax advantage. So in the early years of your ownership as an investor in this project, because of non-cash expense called depreciation, which we can just accelerate under the tax code, this will be a largely tax-free investment for you, at least in the early years of the ownership of this project. So that's great. One of the things we love about apartments as well is that the financing is available. So the credit markets, you probably remember in 23, a big story with the Silicon Valley Bank failure, First Republic failure, Signature Bank failure. Well, that was really close to a catastrophic event for the financial system. But what differentiates multifamily from a lot of commercial real estate, and you're going to hear more about commercial real estate in 24. There's going to be some problem loans, particularly in the office sector. That's going to be a reoccurring theme. But on the multifamily side, one of the key advantages here is that the government, through its agencies called Fannie Mae, Freddie Mac, HUD, guarantee loans for multifamily real estate. And what that means is that there is a ton of capital available at all times for multifamily. And the government does that because multifamily is considered housing that people can afford. And they're trying to promote that. And so unlike a lot of real estate investors, they're going to struggle to refinance their properties or to finance their properties in the office sector or in the retail sector. In the multifamily area, we're not going to have that same kind of credit crisis that I think you're going to see unfold in some of these major cities, particularly in the office market in 24. So that's a huge advantage. And then just the value add. So we manage in the neighborhood of 1,500 apartment units. And so we've got an outstanding team. We know what the operating expenses should be. We know how to increase revenues, reduce expenses, and really enhance value that way through superior management, just based on a great team and a lot of experience. And so we're not simply waiting for rents to increase, which is outside our control. We're actually driving and increasing the profitability through our experience as operators and managers. Anyway, so capital preservation, historically, when you look at how multifamilies performed relative to other assets, in the investment world, multifamily has performed very well in both good times and bad economic times. And so, in addition to potential upside, it's a relatively safe investment in the scheme of investment alternatives. And so, capital preservation, if things go terribly wrong, there's a black swan event, there's a great recession, there's a 9/11 attack. Historically, multifamilies perform very well. Next slide, Jordan. The other great thing is, great thing from multifamily investor perspective is the supply and demand situation. So it coming out of the Great Recession, in the recent pandemic, just far too few homes were actually built. So Freddie Mac estimates something like 4 million too few homes exist in the country. And so when you pair that with increased home prices, increased interest rates, you have a situation where housing is very difficult to purchase for a good portion of the population, and that forces an increasing percentage of the population to rent, and that drives demand. And there's just a lot of barriers to providing new housing. So you've got land use and regulation, environmental challenges, lawsuits, and then as we get into the next slide here, you'll see some other constraints on just adding new supply. Yeah, so I was kind of alluding to this fact. It's remarkable right now with the increase in home prices, with the increase in interest rates. We're at one of the highest points, if not the highest points in history, in terms of the ownership versus rent gap. So right now, according to Marcus and Millichap, Q4, I believe it was, of 23, the cost to purchase a home versus compared to the cost of renting, that gap has never been wider. And so obviously wages are not keeping up with home prices. And again, this is driving an increasing percentage of the population to rent multifamily properties. Next slide, Jordan. So working in our favor, we've seen kind of interest rates spike. That has impacted interest rates adversely, made construction more expensive, made the long-term financing more expensive. But of the big banks that out there, the average rate forecast going forward is in 24, the average decline in interest rates is projected at 1.3%. So that helps our interest costs, it helps our long-term financing costs, and as interest rates drop, that tends to result in higher property values. Next slide, Jordan. Again, so here's kind of the other factor is that we've had incredible inflation, but for the first time in quite a while, in Q4 of 23, we actually see wages increasing at a rate above inflation, meaning people have disposable income to aren't struggling quite as much and have more disposable income to allocate toward housing, which in general is which is obviously a good thing. But given that cost of ownership versus the cost of renting, home ownership is still becoming increasingly unattainable for a significant portion of the population, and again, driving people to rent apartments nationally and locally. So Spokane County, like we're seeing in a bunch of markets nationally, 23, there were a lot of construction starts. We're going to see those added in 2024. Vacancies increased 0.5% year over year to 5.2%. That's still a good rate. But there will be new supply. So between the kind of 4 or 5 major forecasters nationally, in 24, we're seeing projected vacancy rates increase from, perhaps between 5 and 6%, depending on the market. That's still a pretty strong market historically, so it's not a cause for major concern. But what we are seeing in the second half of 23 and into 24 is a dramatic drop off in new permit activity. And so what that means is that the supply of apartments here in 25 and 26, when we actually get our project built and delivered to market, there's going to be significantly fewer units than 24. And finally, it's interesting, the Washington in 1990, a long time ago now, passed the Growth Management Act, and basically they drew a line around the county. And so growth would have to occur inside that line. And then every 5 years, that line is supposed to be updated with the Growth Management Act. And so the next time that's going to be reviewed here is 2025 and probably adopted in 2026 in Spokane County. But and the logic was that you can't have urban sprawl. And so it's expensive to extend roads and utilities and build schools and fire departments just kind of, into suburbia. But at the same time, the boundary line was supposed to be dynamic. It was supposed to be flexible, and that really hasn't been. And so, we've seen over the decades here that we filled in a lot of the developable property inside that boundary. And then you get the pandemic and the big demographic shifts. And all of a sudden you've got supply constraints. And so now this boundary that was supposed to be flexible and expand is very difficult to move. And so it's kind of like, even though you might drive around Spokane and see these, farms and wheat fields, and you think, oh, there's lots of land to develop. Well, the problem is it's outside the urban growth boundary. And so that may as well be ocean. It's really not developable. So it's a constraint on providing a new housing supply that bodes well for people that own multifamily apartments. Next slide. And Jordan, if you want to take this one, people are definitely tired of hearing me talk.
I always make Dave take all this tough stuff, but I think it's good context to lead into why multifamily and why now. And so this project is kind of based on that. So just real recap, you used to be able to go find a piece of dirt and say, put a building on that, and I promise you would have been worth 10% more by the time we were done building it. And I think the difference now is now you have to be super strategic with where your locations are, amenities you put in the space. What does the space look like? Are they functional units? And so that really led to this project, which is the Havana Apartments. We're going to come up with a cooler name, but for now, let's call it Havana Apartments. It's right located on a just less than 5-acre parcel at the base of Beacon Hill, 2 blocks from the river on Upriver Drive, and in a cool pocket of town that gives you really good access north and south to 90, close to the community colleges, and then really offers that Beacon Hill outdoor lifestyle that fits in here. The great part is it's not overpopulated with apartments, predominantly single family homes in the area. And you're seeing the new north-south freeway, which is US 395, is going to be developed one day. Actually, I heard they started that in the 70s. So we are saying one day. They told me they have funding for it, but the idea is then now you have really good access north, south, east, and west, but you're off the beaten path from a location like this. And so we were able to look at the apartments there that maintain high occupancy and really feel like this product will be a good mix in that location. So even more closer zoom on it, you'll see the development here. All these sites up here are actually development single family home sites. This is all single family. This is all park, and then extends up into the last estimate was a $250 million development on Beacon Hill with housing, restaurants, a bunch of different things. And so we targeted this site right here, 4.6 acres, which gives us plenty of room to sprawl out. And so this will be a pretty spacious, well-parked location. And within the unit or within the project itself, we'll have walking trails and things that make it a place people don't just come to live for a little while, but come to stay in a location like this. Then you'll see duplex projects here. This is getting developed, and this is just one of those. They just improved the street here, which gets you pretty quickly to Argonne or pretty quickly to the north-south freeway. So diving in further in the picture, you'll see this is the street view of it. So it's Havana and Buckeye for those of you that, so not Buckley, Buckeye, but it's for all these that know the location. But what's great about it is the soils are great. We did the geotechs, the placement. So we were really able to work within the confines of the site. And as you go up 3 stories, that 3rd story actually has some decent views. You have the mountains in the backgrounds and really nothing blocking that experience. So you can kind of see, not a ton there, but if you drive by the site, it pretty much looks like that because for some reason it was almost 50 degrees today. So here's the layout. And again, anybody can throw a layout on a map and say, let's build that, right? But there's more to it. And I think what I really like about our approach is we start with management in mind first, and then we develop a site. What does the community look like? How do you want them entering the premise? What are the tenants going to say? And so you start with that northwest corner has the clubhouse. It'll have a community space, leasing office for the manager and maintenance team, and really is the gateway into the project. Then as you drive in, we have 3 blocks of buildings that all surround kind of an amenity corridor with, we call it pet forward type amenities with the dog park, trails, things that really a lot of apartments can't facilitate because they're so dense and so parked. And so you'll see here, it really lays out well in a 3 building concept, and then plenty of parking, plenty of additional opportunities for residents, because it'll be one of those sites that likely will plan on two car parks for a 2-bed. So really lays out well. We played with this several times. We really liked what that kind of courtyard design and where it oriented the views for the project. So the unit mix right now is an 18 1-bedrooms, 18 2-bedrooms in that 822 square foot range, and then 36 2-bedrooms in the almost 900 square foot. And so you'll see some of them are going to differ. A lot of things in the valley, the reason price per square foot was so hard is they would build these 2,000 square foot 1-bedrooms, but the rent was less. And so what we tried to find was the exact mix where rent didn't decrease and tenant enjoyment of the space didn't decrease. And so we've been able to test this and sold this product now several times using this mix. We leaned towards more 2-bedrooms just because of the location, and we thought it would accommodate more families of that size. And so things like community gardens, dog walking station, carports, EV chargers, bike racks, easy access to Beacon Hill. These are all the reasons we really love this location. So design features and what's unique. So this is something unique. You'll see the layout here. And to me, first time I looked at these, honestly, it was just looked like a napkin somebody scribbled on, right? But now picture living in each of these spaces. And so what we tried to accommodate was how do you make it super efficient for the space where we can provide that high-end level where somebody doesn't feel like they have to be there for 6 months till they can leave. And so that's our 1 bed, 1 bath. We only have 3 total layouts, which makes it super easy to plan for, to lease up, and to really predict. But the bathrooms are oversized. The other big difference you'll notice in these concepts is that we enlarged the closets for the 1 bedroom. So now somebody moved in there, put the dresser in, kind of it's not limited on space for the layout. And then this is the larger 2 bed concept. And then this is kind of the look and feel of the product, just like the video you saw. And so one thing when we were designing it, I just asked Evan with Trek I just don't want one roof line. Everyone builds one roof line and they paint their building brown, right? So if we're going to do this, what if we just started with the simple things first, the low hanging fruit? And so what's great is we have a 50-year roof on there, 20-year siding, 20-year windows. It's all hardy plank siding. The clubhouse, we added some cool glass amenities. So when people drive in this, our hope is that with these buildings, people are proud to live here. And that's why we need a really cool name. So we're working on the name to make sure it's hey, I live here. Havana Apartments didn't have the ring, so we're still working on that one. But this layout, this concept works. What's great from an investor standpoint is there's not a ton of common amenities. There's no elevator operating costs, minimal lighting, minimal landscape elements, right? All those things that just eat away at the bottom line, which force us to drive rents up in order to hit the returns. And so now we can meet in the middle and offer a product that people can afford and a return investors love, right? And so that's what we really like about this concept. Now, in 2 years, we don't want to build 100 of these. This design. So we'll tweak it up a little, but it's going to have the same kind of look, feel, and something that's just a little different than what you'd see. The other one you'll notice, and you can't tell from here, but if you drive by the actual version, is we enlarged every window. And I think that's one of the key pieces that allow us to rent like this, is that we make it so that it feels open. Our ceilings are 9 feet tall. The windows are large. We have roller shades included. So the cool part as an investor when you drive by these is you're not going to see a ton of stuff out on a deck. You're not going to see blankets in the windows. This should maintain and look like this for the next 15, 20 years. And that was really one of the driving concepts of this whole design. And if you're a part of the 4th Ave investment or part of any of the ones we've done before, it's very familiar, the design. So then you look inside, and what these are like is they should be condo level quality. So from sound deadening, chipcrete and acoustic layers in the floor to LVP plank vinyl surfaces, you should feel like you're coming home. And so one of the cool plan C exit plans is, I think that's a missing middle of housing. So these will be quality enough and designed to a level enough that they could sell as condos. But for now, they're a quality product that tenants can live in. They don't complain about noise or tapping heels on the second floor. The walls, we do double walls instead of stagger studs, all the boring stuff. But trust me, that's the stuff we look into because we get the call. Somebody's playing their music too loud at 11 p.m. But this is kind of the layout design. The kitchens are all stainless steel, quartz countertops, tile backsplashes, and then we carry that all the way in through into the bathroom. So most importantly, the numbers, right? I can show you pretty pictures. I can tell you about locations. We can do that all day. I mean, it's fun, right? But then really, what does that mean to you? Why would you even want to look at this? And so what we're looking at on a project like this, and we keep beating up the costs. Fortunately, we've had a lot of those costs come down. And so really a silver lining of starting in the spring. But we're estimating about a $15.5 million development cost. Our goal is to raise 4 initially, and then kind of just maybe being on the safe side was to raise now $4.5 million of total equity. We're targeting, and basically our projections of stuff we're renting up now put us at just under a 20% IRR return on the money you put in, with almost a 2x multiple. What that means is that we're anticipating upon a sale, if you put 100,000 in, that your return on those funds would be around 200,000. So that's what a 2x multiple would be on that money. And then what we've started doing now is targeting a 5-year hold period, because the worst thing you can do with an apartment is sell it at the wrong time. And so what we want to do is set expectations correctly on a product like this, because we should be able to cash flow. We're working on a couple awesome things, from a triple net lease to a nonprofit who takes the whole thing from day one, to just a great lease up strategy. But that doesn't mean if we don't get that crazy offer, because the market changes and goes back to 3% rates, that we don't entertain an offer in year 2. But this just helps set expectations for investors that that's kind of our hold pattern. And that allows us to withstand dips. It allows us to really, really make sure that we are selling at the right time for this product. And that's me on the bike there. I was wearing shorts and they changed it up. So we'll get a better picture in there next time. So then we kind of move into what's the official schedule look like. And so our goal is a groundbreaking on May 1st. So we have permits ready. It's a 10-month build. So from the time they start breaking ground to delivering the final certificate of occupancy will be about 10 months. We are targeting an 8 to 9 month lease up period in this. And now again, we'll be pre-leasing, we'll be pushing those pieces, but again, on the sake of basically under promising and over delivering, we're targeting that amount, which would put it roughly 9 leases per month, which we feel is very doable. The initial distributions, because it's a development, essentially we're targeting 24 months after we break ground to start getting the cash on cash return. And then obviously a sell or a disposition event triggers that cash as well. And then we're working on transitioning to permanent loan financing. So the loans we're looking at now are permanent, or sorry, construction that convert to permanent, but on a 5-year hold, some of those products Dave was talking about are super lucrative once we're stabilized. And so that's really what the schedule would look like as we're doing it. Again, 72 units. We really like the play. The reason we do development, I guess this begs the question, right? Why don't we just go acquire this asset? And what we're trying to do is build in some margin for you where you don't have to go buy retail. So when we're targeting this, we're looking at a cost to do it of 15.5, but our estimated future value and appraisals we have are close to 20 million. And so as you invest in this, because you own a percentage of the LLC, you actually benefit from this development risk, they say, for getting it built. And that's one of the reasons we like development. A, it's a new product. So we know what's behind the walls. We know what's in the wall. We know everything about this building. But then we're also able to carve a margin into a product like this that we pass directly to, like I said, the investors involved. So that's one of the big reasons we like it. We're targeting a cash on cash of 6%. And there's some numbers you could have construed that. We could have said, well, that doesn't count principal and depreciation, which it doesn't, right? But it's also one of those cool benefits of a tax benefit of real estate and what that actual return is to you. So that's a true cash we collect versus cash we raised on. So then you'll see an IRR of almost 20%. And again, I'll send out definitions after this because it's kind of a cumbersome little number to come up with, but essentially it's your return on the project. Our minimum investment right now is 50,000 for the deal, and the split we have structured as our management team has a 20% equity stake, and then we split up the 80% between the limited partners. And again, if you have questions, feel free to fill out the question and answer because we'll be diving right into that as well. And some reason I move fast. I haven't learned to talk slow. I'm from Moses Lake. I think everything had to be fast there. So from fast food to fast boats, right? So the next one is how our process works. So obviously you're on this webinar. You have some interest, some part of it. The goal would be to get in touch with us. We basically find the deal. We have access to this awesome portal that has all the information on there, everything you can get signed up for. It has some screening stuff for investors. And then you decide on your allocation. What's awesome is you track everything else from there. And so the cool part is our hope with this is that we're picking up the heavy lifting. Like I was meeting with my buddy, he's an attorney, he was talking through stuff, and it just went right over my head. I'm like, and I'm an attorney, I passed the bar. And I'm like, this is crazy. But he does it every day. To him, it doesn't go over his head because he's in it every day. And that's kind of what we offer here. And then your ability to track it though. So the goal of this, our entire 4CAP is super transparent, it's like basically showing you how this is all done. That way it's not just put the investment in. Again, you don't have to do anything, but our idea is to allow you tons of ways to track from the link to that on-site camera that you can pull up anywhere, anytime. It's a really cool Christmas party trick. Pull that thing up and start showing everybody what we were building. And then ultimately we manage all the way through disposition for you. So it's one of those super ones, the 4 guys at the top to get to with questions. But that's essentially how that part would work. And so our goal with this webinar was to kind of answer a ton of questions. We were just getting so many on this product when we finally put it together to go raise. And so the idea was to answer a ton of questions, have a piece of material you could go reflect, go look back on that, and hopefully address it at least at a high level. And then our hope, and Dave will speak a little bit more to funding amounts, timelines, and that kind of stuff. And then we'll jump right into the Q&A.
Yeah, if anybody has any questions, we're always here. Feel free to contact Jordan or myself or Matt or Joel, and we're happy to meet. And then just, we're targeting a closing date of March 15th. So we've got a little bit of time, but we want to get things lined up. and it will be a first come, first serve. Although I guess, yeah, typically that's how it works. We could, I guess in theory, reduce people's investments pro rata, but typically it's first come, first serve. Yeah, and we're here. So we try to be a little bit different. So we invest, locally, and we're focusing on local folks who want to invest their capital here in Spokane and make a difference. And we'll have quarterly events for investors. Jordan undersells his entrepreneurial capabilities along with his brother Joel. We'll meet down at Brick West, where these guys are owners, and just networking, get together. We can talk about projects, but we're always here. We're in town, and love to meet and answer questions. So, yeah, let us know if you need to get together. Otherwise, Monique in our office and myself and Joel will, if you have any technical questions on getting set up in the portal, we can certainly help. And that's typically the first step. And then, yeah, talk about the investment amount, and we'll get contact information if anything's missing. And then we can forward documents through our investor portal to you. Or if you prefer to come in and sign, hard copies, that's fine too. But we can walk you through that process pretty streamlined. And then, like Jordan said, that investor portal allows you to just kind of watch the progress of the project. You can see the time-lapse video. You can see your P&Ls and balance sheets and distributions, contributions, distributions, the return on investment metrics. So it's all there in your secure investment portal location.
Yeah, it's super cool. And again, I love it. Like, I love watching studs. I like framing. And so that's kind of what passes through to 4 Degrees Capital, whether it's scheduling, hey, you don't have to be to any of this, right? But hey, we're going to set up an investor walk, and you get to see some of this stuff and ask those kind of questions. And it's all those questions I wish I had somebody to ask when we were getting going. And so that's really kind of the foundation of it. But I wanted to jump into some of these questions, and kind of we'll go between me and David to answer them. I haven't pulled up. But the first question was, is there a minimum percentage of occupancy needed to drive IRR? When we do our underwriting, we were estimating that 5.2% vacancy. And so that's what's driving our IRR. So our hope is to maintain closer to 3% vacancy. But when we're underwriting, that IRR is based on the life of a 5-year hold at 5% vacancy.
Actually, on this project right now, we're a little higher, Jordan, closer to 6, just
6? Okay.
kind of as a margin of error. Yep.
Sweet. Thanks, Dave.
Yeah.
And then our current portfolio, which is a mix of multifamily and single family duplex. So it's a little skewed in that direction of the 1500, but I'll get with Joel and come up with the answer. But the last time we had talked, it was around 3%. I mean, any existing product that had people in it, we haven't had trouble. Where you're seeing a lot of the vacancy pull is the brand new units get put into that mix and they drive vacancy higher. So we're delivering another project, 107 units. Well, immediately when you do the report for vacancy, you're going to have 107 units not rented, which will drive up the area vacancy rate. And so that's what you're seeing, a little bit of it that's driving it. But the existing stuff that we're able to turn and put in there, and a lot of the other vacancy, you have to remember, we delivered a ton of units when build costs were at their peak, from cost to build, supply chain issues. And so those rents have to meet it in order to hit a return. And so they were building projects at 9-10%. You had these delivery things. And so I think by the time something's delivered here, you're going to see a little bit of that settle down, like Dave said. And a lot of the mentors and people I'm talking with are super optimistic. They call it the golden era of development will be 26, 27, because everyone will have stopped now. And a project like this is really 2 years in the making, almost 2.5, really, by the time we stabilize. And so that's a little bit of, when they talk about risk, it's a little bit of that, of you just don't know what the market necessarily looks like, but everything we're looking at is trending towards vacancy kind of holding in that perspective. So our current rate of occupancy, sorry, I didn't say vacancy, would be about 97% on that portfolio we currently manage. Could you do a sample cash on cash return and final equity payout for an initial investment of $100,000, Dave?
Sorry, didn't quite understand that. So
so if I put $100,000 in and I get my cash on cash dividend return, and then we sell the project as projected, what does it look like for my final equity payout?
Oh,
like, what would we have in mind?
Yeah, so the way we run the numbers, if it says a profit multiple of 2.0, that includes your cash distribution plus the net sale proceeds, your percentage, your pro rata share of the net sale proceeds. And so that's kind of how the Jordan alluded to this internal rate of return calculation. And that's the finance industry, real estate industry uses that return. It's not widely used outside of this kind of world. But what that does is adjust for the time value of money and the timing of money. So, for example, if I loaned you $100 and I said you have to pay me 200 tomorrow, that's a pretty good deal, right? But if I said you give me 200 in 5 years from now, well, that's not worth as much. So it's the timing of the cash flow that is a part of that internal rate of return calculation. And so when we're running those numbers, the system or the model basically calculates your investment at time period 0. The construction, let's call it in time period 1, would be year 1. And then when you start to get your cash return, return on investment in year 2, and then you get the year 3, and let's call it year 4, and then in year 5, we sell the project, you get that. The internal rate of return is a calculation of that cash flow plus the net sale of proceeds, which it works out to about 20% annualized return. And so in that case, it's the cash flow plus the net sale proceeds equals, approximately a profit multiple of 2x, or doubling your money over that period of time. Did I explain that correctly, Jordan?
Well, I mean, I tried flow charting it, but I think that hit on all of them. So, but again, it's a mix of both your cash on cash return that you're collecting on a dividend, but then also the sale proceeds when we go to sell the asset. So,
Yeah.
Yep. Which leads right into the next question. What is a DS? And I'm assuming it's a DSCR, debt service coverage ratio, for the project. And so we're targeting a 1.25. I believe this actually ticks just above that at 1.27 to 1.3. How does it affect the selling of the properties on the site? I mean, it's everything, right? So for a while there, it was all about LTV. So in a low credit environment, low rate environment, it's all about LTV. Can you hold the value, and then we'll give you everything up to that. But now what you're seeing is most projects, and why a lot of projects stop, is because it's constrained by this ratio. Good. I don't know. Some people love and hate the ratio, but what it's saying is for every dollar of debt, you need $1.25 of income, right? And that's the ratio. So what's really cool about a product like this is we'll meet that from the start, but then also when we're looking at debt, that if we go Fannie, Freddie, or HUD, is all assumable. So if we lock in a low rate and rates change a ton, that note would be assumable, but those have fluctuating DSCRs anywhere from 1.17 to 1.25. So it definitely affects it. It's something we're very conscious of, but we are building in what I think is kind of the height of some of that DSCR requirement for what we're looking at. And so some people will be constrained on that. And again, the cool part about Spokane and a project of this size, because it has management basically paid for by the property, it has the maintenance, all those, is that the type of buyers that are looking for this will not be local buyers. So one cool connection we have is I was able to fortunately sell about $125 million of commercial properties last year. And so it's the connection. So when we're ready to sell, this list goes to 15 top buyers in our market. And a product like this is the type of product somebody would love to enter a market with. And so sometimes, even though your DSCR can be constrained, you can always bring more cash to mitigate that. So when people like the asset, so our focus is on build an asset that people like, build an asset that people can manage, build an asset that actually holds lower operating costs, from cost to the tenant to cost to the operator. So I think it will play a role always, but that's a number we've put in to all of our calculations for it. And then how many investors are you looking for? So it's first come, first serve. So once we fill up and we hit the total amount needed for this, if we raise too much more than that, it dilutes down the return to other investors. So if that's 5 people, if that's 10 people, but it'll be a group that kind of, like I said, aligns with some of the hold times and just assets for this property. And so Our goal is to do this. We've already raised, like I said, more than half of the proceeds, and this would be kind of that final portion. The bump from 4 to 4.5 was also to take into account reserves and just being a little more conservative on that piece of the project. But like I said, if one more investor comes in, takes out the rest of it, then what we do is still get you enlisted on the portal. And then as our deals come up, you get first shot at them for being kind of in that circle. You still, like I said, getting signed up and still get you access to all of our events and fun stuff like that. But really are just targeting getting all the funds in this month, February, getting our term sheets out and finalized with the lenders. And then we're going to break ground on this thing. So, and somebody told me we should start doing groundbreaking ceremonies, but to me, that's not the hard part. So for me, it's like, we could do something cool like that, but most of ours is celebrating when it's done and celebrating the investors and the team that get it done. So, I think I just dodged your entire question, but the answer is it's not there's no limited number. It's just first come, first served to the total. And then
Hey,
I think,
Jordan, one thing,
okay.
one thing I would add on that, just so people, because DSCR stands for debt service coverage ratio. And for those that don't deal with this stuff very often, it's just a lender requirement that says you've got to have cash flow that exceeds your debt service, meaning your monthly loan payment by a certain amount. And so we always start with the end in mind. How are we going to pay off the construction loan? And so we focus on what those permanent loan requirements are through HUD, Fannie Mae, Freddie Mac. And so we have a pretty good understanding, in fact, a very good understanding of what that permanent loan terms are. So going into it, there's always markets fluctuate, but we build in a margin of safety, a cushion, so that we've got enough room there to make sure that we get the permanent loan in place and pay off the construction loan and lock in the long-term, cost-effective interest rate.
Well stated, sir.
All
All right. Well, so if there's no more questions, we're going to wrap it up. Next steps would be feel free to reach out to Matt, David, or I, or just go to the 4CAP part. And we will get you signed up, or at least in the portal, go through some of the screening stuff, and look forward to answering any more questions. And like I said, looking forward to getting this project going. So thank you so much for yeah, go ahead.
Might have another question there, Jordan.
Ooh, we have two more. What is the stabilized value anticipated again? And can I get a copy of this presentation? Yes, the reason we recorded this was so that we could do this once and everybody can get a copy. And then the stabilized value anticipated is based on the appraisal. So we'll share that appraisal with you. It's in our docs and you can see where it's at. Now, again, that's one of those fluctuating ones. So we're just super transparent with it's what it's appraised at now. There was a point when I was trading large multifamily in the high 3 caps, which would adjust this value by 2 to 3 million. And we're seeing them kind of flatten out. I haven't seen much new construction drop too much below 6.25. So we use that as kind of a high end. And then for us now, we use the appraisal. But I believe it was, Dave, correct me if I'm wrong, but I believe it was 19.196. Something like that for the appraised value of the project.
Yeah, in that.
Yeah.
Right.
And so 15.5 build costs and then a 19.16 exit. And like I said, we're still working on some of the fun ones where it's this contract with a nonprofit to take over as a master lease of the entire project. And so it's an LOI. We didn't want to put in this presentation as a formality yet, but it's some of the things we'll be working on prior to this thing even being close to done, which would help that return, help that exit, and all those parts.
Yeah, and really be a sweet deal from the standpoint of just eliminating or nearly eliminating risk to the ownership if we've got one nonprofit master leasing the entire project.
Yeah, and it solves kind of my triple bottom line of what I look at is like, how can we also help the community? That's why we like doing these kind of as local presentations as well. But it was one way where they have a ton of rent dollars, just not a lot of development dollars. And it would cost them, they were saying, almost $100,000 per door more to build this exact same product we're building. And so for them, if they can lease it from us for 5 years and then have 5 years for a capital raise, this would fit. And so one of our models might be helping this nonprofit hopefully provide more and more housing to the middle moderate level income group, not low income housing, but moderate level group. So they can help fix rents and do some of that stuff. So Anyways, pretty exciting. This recording again will be available. If you were on here, we have your email, so it will be emailed to you as well, along with a link for next steps. And then once it's there in the portal, we'll have it. If you know somebody that missed this or missed this opportunity, feel free to connect them with us and we can take it from there to get you more info. But I know it's Tuesday night, 6 o'clock. I just want to thank everybody for your time. And again, really excited about this and really excited about continuing to grow the 4 Degrees Capital Investment Group. Thanks again.
Thank you, everybody.